Good afternoon, Peter.
Glad to see you, Michael.
Glad to see you too. Well, this is our tax dialogue from Global MBA Tax Management and Compliance of the Facultad Brasileña de Tributación. We have the great honor to interview Peter Barnes, who is a very sophisticated person and tax lawyer, who is a professor in New York University. He was a professor in Duke too, and is the chairman of U.S. IFA as one of the biggest think tank in taxation around the world. Thank you, Peter, for your time.
Glad to be here.
Well, Peter, our topic is the U.S. tax system and the e-commerce. So we will talk about in two parts, but I try to connect because United States, as you know, have the at least federal government for the federal income tax have the position different to the OECD and BEPS according to the e-commerce. So, what is the tax system in United States, and if you can compare with another tax systems in?
Well, let me be clear. I'm not speaking. Yeah, I don't speak for the U.S. government at all. I had the privilege of working for the government for 4.5 years in the Office of Tax Policy, but that was several decades ago. The United States at the federal level does not have any special rules for the taxation of digital commerce or digital companies. And indeed, I think the U.S. views singling out digital companies for special treatment as inappropriate. Obviously, the Pillar 1 exercise at the OECD is targeted at U.S. digital companies, although other companies eventually will be swept in as well. But the United States treats digital companies just like everybody else. And in particular, that's because there's almost no company today that doesn't have a website, that doesn't take orders over the website, that doesn't download some materials for its customers. So the U.S. has a global tax system. We tax income no matter where it's earned by U.S. corporations, and we tax their subsidiaries' income as well all around the world. But it's with a broad-based global tax system. It is not with special rules about digital companies. Now, at the state level, we're beginning to get a few states that are implementing new rules aimed specifically at digital companies. But that's a very minor part of the tax landscape. At the federal level, the U.S. treats our tech companies just like it treats every other company.
Okay, so the United States criteria is worldwide, and in general, all the Latin American countries use the same criteria, except Costa Rica, Uruguay, Panama, Bolivia, but the other countries in general use the same criteria. But for example, try to compare with the United States. In Peru and other countries who use the same criteria, we create our income tax as a hybrid, because take the United States worldwide criteria, but use the income tax nature in our law. In Europe, the income tax is according to the accounting P&L. In the United States, there are two tax books, accounting books, there is a lot of difference. So the reconciliation is important for tax purposes. Here is a hybrid, but in the United States, there is a lot of problem or litigation when something is accrual for accounting or not accrual for tax purposes.
Well, let me respond to that. I think almost every country, or I'm not aware of any country that does not make some book to tax adjustments. They may have a different rule for depreciation schedules under tax and under book. They may have differences for bad debts. They may have differences for the timing on accrual of income. But there's no doubt you've put your finger on an important point. The United States has more adjustments when you go from accounting income to tax income than most countries. Most countries, and I've worked in dozens of them, there will be 4 or 5 or 6 significant adjustments as you go from accounting income to tax income. In the US, it's 20. They're bigger and there are more of them. But let me step back to a point you're making. The United States and every country in the world has a tension over what we call capital import neutrality and capital export neutrality. And I don't want to be pointy-headed on this, but the general issue is you don't want to incentivize your companies to go to foreign jurisdictions in order to get a lower tax. So you would like the company to be taxed at the same rate, whether the income is earned domestically or earned in a foreign country. At the same time, you don't want to disadvantage your companies if they're competing in a country like Ireland with a 12.5%, or even Bermuda, where the tax rate is 0. The United States, after 2017 legislation, has struck the balance between capital import neutrality and capital export neutrality by saying we will tax U.S. domestic income at 21% in our corporations, and we will tax foreign income currently in the year it's earned at 10.5%, or in some cases it goes up to 13%. So it's a balancing act that says we recognize that some countries around the world have lower tax rates, and we don't want U.S. companies to be disadvantaged. So as long as you pay 10.5% for your activities outside the U.S., then that's enough. But if you pay less than that, we're going to top up your U.S. tax to 10.5%. At the same time, the U.S. rate is 21%. So it's a tension. And I think the U.S. and every country is trying to figure out how to make sure there are not incentives to go earn your income offshore, but at the same time to make sure your companies are competitive in other countries where the tax rate is lower.
Okay. Returning to the biggest tax systems idea, in the United States, correct me, Peter, if I'm wrong, there are income tax, federal income tax, tax sale, our VAT, value-added side, but in your case, it's monophase. It's just only the final contributor. So, what other big taxes apply for federal purposes for the states?
Well, you certainly have touched on 2 of the biggest ones, and there is a third one, which is a state income tax. So at the federal level, you pay federal income tax. And if you're in certain businesses, you may end up paying excise taxes. We have significant excise taxes on alcohol, on gasoline. But there is not, as you say, there's not a consumption tax, not a VAT or sales tax at the federal level. At the state level, you have sales taxes and you have income taxes. The income tax rates in the states are usually much lower, 3%, 5%, but in some cases they're up to 10 or 12%. So they're much lower than the federal rates, but they're not insignificant. Most states have both an income tax and a sales tax. A few states have only an income tax or only a sales tax. But companies do absolutely need to plan both for compliance and for economics to be sure they're able to take into account the state income and sales taxes in their business model.
Okay, and how it worked your process of NAFTA in the integration with your sales taxes in the inbound and outbound commercial export or import products. I assume apply the same criteria to the VAT, only pay in the people, the country who use. Okay.
Yeah, our sales tax conceptually is really a single level VAT that's levied only at the time the ultimate consumer purchases the goods. So if you export from state A to state B, there will not be a sales tax in state A. There will be a sales tax collected in state B where the goods are consumed. One major change in the U.S. over the last 3 or 4 years does affect digital companies and companies like Amazon that deliver hard goods. We have traditionally not required a company that is based in, let's say, California, shipping goods to someone in New York to collect the New York sales tax, unless the California-based company had a presence in New York. So the California company would ship the goods to New York, and there was a legal burden on the recipient to pay the New York sales tax, but that did not often happen. Legally, the tax was exactly the same level as the sales tax, but it simply wasn't collected. Over the last 3-4 years, most states, blessed by a Supreme Court decision called Wayfair, most states have invoked new rules that say if a California company has significant sales into New York, then the California company must collect the New York sales tax from its consumers and remit that tax to the state of New York. That's not different really from the VATs around the world, where if a company has significant sales into a country, it can be liable for collecting and remitting the VAT, even if it does not have a taxable presence for income tax purposes.
Sounds great. It's similar to Brazil. In Brazil,
yes,
it's a tax sale.
Right.
The other taxes that in Latin America is important to know is about the labor taxes for employees, for employer. Because, for example, here in Peru, for each dollar that a company pay a worker, the real cost is $1.6 because there are extra costs, social contributions, pension, 14 remuneration, not 12, etc. Profit sharing and labor who apply over net profit for tax purposes, but it's based for share the profit. It's not in all countries, but in some countries exists. In United States, in general, the cost for each dollar, how much is the biggest tax labor? Could you explain us, Peter?
Certainly. It's the U.S. system has significant additional costs, but they're not technically taxes for the most part. We do have social insurance taxes, which are generally in the 7 to 8% range. So if you pay somebody $1, it actually would have a cost to you of $1.07, $1.08. But we have a different system, as you undoubtedly are aware, in the U.S., and that is that most of our health insurance is supplied by employers rather than a national health system that most countries have. So it is quite expected by an employee and an employer that unless they have more than just 2 or 3 or 4 employees, once they become a significant business, they will provide fringe benefits, and those fringe benefits would be health insurance and perhaps some help with retirement savings as well. So those costs can be quite significant, and particularly significant for as a percentage for lower wage employees, because if you're paying health insurance that costs $8,000 for a person, and the person is earning only $20,000, then that $8,000 charge is 40% of their wages. If you're paying $8,000 and the employee is earning $100,000, then the healthcare costs are only 8% of the employee's wages. But we have significant additional costs because our healthcare in particular, but also support on retirement payments are often borne by the employers in the form of fringe benefits to the employees. Those are not technically taxes, though, the way they are in countries like Peru and like many, many countries where the government runs the retirement system and the healthcare system.
Okay. Yeah, because in the United States, the pension is assumed by the company. Company have the funds.
Well, so, yes and no. Historically, yes. Historically, the company would retain the funds, invest them in a pension trust, and bear the economic risks of the pension that it promised the worker. Over the last 30 years,
something like Enron happened.
Right. Over the last 30 years, that has changed, and changed almost completely, to where now an employee will contribute a certain portion of their salary. The employer will contribute a certain portion of the salary. That will go into an account that is maintained by a fund company. And the risks really are left with the employee as to whether that savings amount is high enough, it grows enough to provide a strong pension at the end of their career. So companies do support the pensions, but they do it in a way that is a contribution to an account in the name of the employee, and without the employer bearing a long-term economic risk with respect to pensions.
And that amount in the accounting bank is administrated by private pension fund?
Asset managers, Fidelity, Vanguard, State Street Bank. There are a number of large fund managers. And typically an employee will put in somewhere between 3% and 7%. The employer will match that somewhere between 3% and 5%. So an employee who's saving aggressively might have 10% or more of their salary put into a retirement plan, but another employee may put nothing or have the employer only match it at a 3% level and have a smaller contribution that's growing. And this is a worry, because certainly some employees are very prudent and very fortunate, and their pension contributions grow over 20, 30, 40 years. But there are other employees who don't save very much or just have bad luck in their investments. And that is a worry. Now, this is in addition to Social Security. We do have a Social Security system, but our government pensions are not intended to fully replace your salary. And so private pensions are important. The government pension is capped and is not as robust as some countries.
And now, from the outbound perspective, when U.S. companies invest in another countries or provide service, digital economy, or other intangible contract from the United States to abroad, as I know, you have a very interesting foreign tax credit in order to, because the United States don't have double tax treaty with all the countries around the world, and in Latin America only have with Venezuela. And as I understand, you avoid that double income tax with FT, foreign tax credit, FTC. And could you tell us how it works? Why do you have success with this method?
Well, I wish we had more tax treaties, but the United States is more generous than some countries. We provide for a foreign tax credit even if there is not a treaty. So certainly there are some countries around the world that provide double tax relief only in the case of a treaty country. But the United States has some complexity around how its foreign tax credit process works. But in general, if a U.S. company incurs taxes on activities outside the United States, we will give a credit for income taxes incurred in that other jurisdiction. And we have rules to determine whether a tax is an income tax or not a creditable income tax. For instance, VAT taxes do not count as creditable taxes. The complexity comes in calculating how much of the foreign tax credit can be used. It can only be used against the U.S. tax on what's known as foreign source income, because we don't want a tax incurred in Brazil, Peru, Mexico to reduce tax on U.S. source income. Income earned in the U.S. should be subject to the full 21% U.S. tax rate. We also have a different process if the foreign tax is incurred by an affiliate, by a subsidiary, versus incurred by the U.S. company itself. So we calculate at the level of the subsidiary, or really all of the subsidiaries, whether there's sufficient foreign taxes incurred that there's no additional U.S. tax, or whether there should be additional tax. One of the interesting things about the current global debate over the so-called Pillar 2, the global minimum tax, is the U.S. already has a global minimum tax. We have one in place. You can argue whether it's sufficiently strict, how it should be administered. Is it too complex? I mean, lots of debate over whether the features of our global minimum tax are appropriate or not. But the U.S. does have a global minimum tax. And so the debate in the OECD and the G7 and the G20 over global minimum tax is layered on the fact that the U.S. already has one. Now, ours is not completely compliant with the proposals as they're developing at the OECD. In particular, ours is computed on a aggregated basis. You combine your activities in all foreign countries to determine whether the tax rate is sufficiently high. The proposals suggest that it will be on a country-by-country basis. The U.S. rate is also 10.5% to 13%, and the proposal is clearly for 15%. So the U.S. global minimum tax is not identical in any way to the Pillar 2 tax that's being developed, but we do have one. And that is in contrast to most countries, which certainly do not have a global minimum tax today.
Okay. In the FTC, the United States allowed the carry back credit and carry forward.
Yes, but in a limited way. We do have some carry back and carry forward rules. They are different. We actually split up our foreign taxes into what are called foreign tax credit baskets. We don't just throw them all together, and the different baskets have different carry back and carry forward rules. But we do have a limited carry back, carry forward, so that if there are timing differences between how a foreign jurisdiction computes income and the U.S., there's at least some carry forward, carry back that smooths out those timing differences. Not perfect, but there is some relief.
I assume one of that basket is for the derivatives, financial derivatives.
No, we're not that narrow.
Because the derivatives create a lot of problems for a lot of companies.
Well, they do, and certainly the U.S. Struggles, as every country does, with financial products, and today, of course, cryptocurrency. Trying trying to make sure, in particular, that taxpayers are compliant. And interestingly, 2 years ago, the United States changed its tax return form, the sheet that people fill out, so that question number 1 on page 3 of the return says, have you invested in crypto assets? And so the taxpayers must directly say yes or no. And you can no longer have crypto assets but not reveal that to the IRS. So that's a step towards giving the IRS the ability to track and trace and tax crypto assets.
Sounds great. So the second topic, economic, digital economy in taxation. What is the United States perspective of this? Because, well, from our perspective in Latin America, well, the biggest player are U.S. companies and Chinese, and well, European, Africa, and we as Latin America, we're consumer. We have startups, some Mercado Libre, and some unicorn company, but it's tiny compared with the United States and Canada companies. So we have the what is the view of OECD BEPS about the plan one BEPS plan action?
Well, this would probably take an hour, Michael. So let me give you the very short response, and then we can take an hour on another occasion. The U.S. does not really think there's a reason to tax a company that does not have a physical presence in a jurisdiction. For 100 years, international tax principles have said that if you do not have a physical presence or presence through an agent, that you should be subject to income tax. You may be subject to consumption taxes, but not to income taxes. That said, the United States, and particularly under the current Biden administration, recognizes that the world has a different view. And so under the leadership of Janet Yellen, the U.S. has played, I think, a constructive role in the Pillar 1 discussions. But there's no particular reason to target just Silicon Valley, California, successful digital companies. And let me take a contrasting example. Let's take Aramco. Aramco is one of the world's largest companies. It pulls oil out of the ground, refines it. And so if you go to France, Aramco could sell $3 billion a year worth of oil to French customers. And no one would ever suggest that Aramco should be subject to income tax in France. And yet if Netflix or Uber or Google or Amazon sells services to French people with no presence in France, we somehow feel like, oh, they should be paying income tax in France. The difference between those two situations, I don't think, has been adequately framed up. And indeed, I'm disturbed that the Pillar 1 discussions suggest that banking companies and extraction companies will not be subject to the new rules. But the U.S. is playing a constructive role in trying to identify some highly profitable companies, both U.S. and otherwise, who will be subject to a tax without regard to whether they have a physical presence in a market country. And that tax will collect some amount of money that is then distributed to the market countries.
That idea that you mentioned.
Yeah, Michael, I'm going to need to go. I apologize. And I'm happy to talk another time, but I do need to go.
Great. Thank you for your time, Peter.
And I hope you can get something out of this that's helpful to you.
Yes, of course. Thank you again. See you soon.
Thank you. And I'll look forward to 10 days from now.
Yes, in the classes.
Great.
Bye-bye.
Thank you. Thanks, Michael.